The Federal Reserve on Wednesday today raised interest rates by 25 basis points, the first rate hike since 2018. This was in line with market expectations, and we'll be discussing the Fed's possible next moves with Professor Steve Hanke. He is a professor of applied economics at Johns Hopkins University. Welcome back, Professor.
Good to be with you, David.
Professor Hanke, let's talk about market reactions to the Fed announcement today. 25 basis points was in line with market expectations, but then why the rally in stocks? The S&P 500 is up 2.2% as we speak today, right after the Fed announcement. Gold's up a little bit. The dollar is slightly weaker. So you're seeing risk assets move up and gold as well. What's going on with the market reactions? How are investors interpreting this move from the Fed?
Overall, given their statement as well as the 25 basis point increase, I think the interpretation is that the Fed is remaining relatively dovish and remains behind the curve. And in other words, behind the inflation curve. They're not. The market is essentially saying they've decided they're not going to aggressively attack the inflation problem that we have.
Okay, so let's talk about gold then. Gold's reaction. We're seeing gold slightly move up today on the news. So the gold market probably is interpreting like the stock market is that inflation won't be brought down anytime soon. So I guess people believe then that the inflation narrative of being transitory is wrong, right?
Right. It's definitely not transitory, even though people are not interpreting this transitory versus more permanent story correctly, because they're saying the reason the transitory story is drung on and on and on and been a lot longer than everybody thinks is that these supply chain problems are still plaguing us and still with us. And the reason that we have inflation is because of these supply chain problems. In fact, the reason we have inflation is because the money supply has exploded since the pandemic started in February of 2020. The money supply measured by M2, which is the Fed's broadest measure, is up over 41% since then. That means an annual rate of increase of about 20%, which is unprecedented. It's all from the money supply. But you read the paper like the New York Times today, I read it and couldn't believe it. They're still droning on about supply chain problems and the fact that those have not been fixed as fast as people thought they would be fixed. And that is the reason why inflation has been dragging on longer than people thought, which is complete malarkey. It's my 95% rule. 95% of what you read in the press, whether it's the New York Times or elsewhere, is either wrong or irrelevant. And the article in the New York Times was irrelevant today and wrong.
Okay. Well,
never got into the money supply. It never got into the money supply problem.
They didn't contact Professor Hanke to write their op-ed for them. That's what they should have done.
Well, this wasn't even an op-ed. This was just supposed to be reportage by reporters who cover this day in and day out, and they just repeat the same narrative that they're given by the Fed. That's what you read in the newspaper. It's just literally propaganda and disinformation at this point.
Well, we live in America, not Russia, right? I mean, how can we?
Well, that's true. There's enough disinformation going around, David, to sink a battleship right now.
Oh, Jesus. We're going to come back to the Hanke-Cofnas index, but I want to talk about inflation since you brought it up. I like these hypothetical games with you, okay, because it really brings out the way you think. Let me just give you a hypothetical scenario. Imagine a world where the money supply hasn't gone up in the last 2 years. It's just, M2 just stayed flat. Now, all of a sudden we have a pandemic. Let's say the government doesn't respond with quantitative easing and M2 doesn't move up. The pandemic hits. We have a supply chain crunch. Logistics are in shambles. Shipping lanes are cut, so we don't have the usual logistical smoothness that we used to have. Now, all of a sudden, because of this, oil prices spike because you can't get oil. The supply crunch is catastrophic. In that scenario, Professor, would inflation still go up because oil feeds into broader energy, and everybody needs energy for their fixed costs. So the fixed costs go up. Wouldn't the rest of the market go up?
Oil prices in your scenario, your hypothetical, the oil price would go up relative to other prices, but the overall aggregate price level in that scenario would actually probably go down. Now we have what you've just given me, we have a real world example that's pretty close to that. 1979, 1980, Japan. We had the second oil price spike, okay? And that was 1979, 1980. We didn't get an increase in inflation in Japan. And the reason why is the Japanese kept the money supply growing at a very slow rate in 79, 80. So that what my response is validated by looking at Japan in that period, 1979, 1980.
Okay. Oh, that's a good example. All else being equal, Professor, what do you think is better for an improvement in living standards? Inflation or deflation? Let's suppose you have, single-digit inflation versus single-digit deflation. What would you prefer as an economist?
This is a hypothetical.
I suppose, yeah. Well, we did see Japan witness deflation throughout the 90s.
We've actually had two periods of deflation in the United States. The first part of the 19th century and the very last part of the 19th century. And the last part of the 19th century, remember, we were on the gold standard then, and the standard of living improved.
Okay.
People's purchasing power increased. So that was kind of, shall we say, a healthy deflation. Now, go to the Great Depression. That was an unhealthy bout of deflation that we had. So it depends.
Right. The context matters. Okay. Right. Oh well. I guess I think what matters most is the real wage going up. If you have deflation or even have slight inflation, if your wages are climbing faster than the growth of consumer prices, then I think you're doing better than you were the previous year. So
you want your wage adjusted for inflation, what they call the real wage, to be going up. Then you're better off if your income. Let's talk about just income in general, whether it's you're getting wages, dividends, stock returns, and if your income, your real income, that is the income adjusted for inflation, is going up from a narrow economic point of view, your standard of living is going up.
Yes. So let's talk about that. Let's talk about the income side. I know that you've given your inflation forecast 6 to 9%, and you said that it's going to persist into 2024 because the M2 is going to stay elevated until that period at least. And so that's your forecast. We've talked about that before. Let's talk about the income side. Do you think wages then can grow by at least 6 to 9% well into 2024?
Well, this depends on what they call inflation expectations. And if people look at what I'm forecasting, and that is that we already have baked in the cake right now, we know that going into 2024, the inflation, given the excess amount of money the Fed has incorrectly produced already, that the inflation will be 6 to 9% going into 2024. If people grab onto that and their inflation expectations change and increase, they will be bargaining for wages that accommodate that inflation. So if they anticipate the inflation correctly, they will demand higher wages. If they do not, if what they call the inflation is unexpected, they won't increase their wages as fast as inflation, and their real wages will fall.
Well,
so it depends on what they expect and how they're bargaining.
That just sounds like prudent salary negotiations, Professor. You should always expect price inflation every year.
Well, you should, but the question is how much, you see.
Yeah.
And if people don't properly get the right inflation expectations and they aren't high enough, their wages in their bargain won't be that high and they'll be falling behind on an inflation adjusted basis. And that's what's going on right now. They have not anticipated what I projected with John Greenwood in July of last year, and that is that we'd have 6 to 9% inflation right now.
Correct.
Generally, people didn't anticipate that, and so their wage bargains weren't in line with that kind of inflation because they didn't expect it. It surprised them, and as a result, they're falling behind.
Okay. I do have one more question on inflation, and we'll move back to your gold sentiment index, which we'll talk about. Now, Professor, so some people watching this might say to you, well, I've negotiated with my employer, and suppose they've already given me an 8% increase this year. It just so happens that it's in line with actual inflation, at least reported by the Bureau of Labor Statistics. But I'm noticing that my living standards have still decreased because 8% isn't reflective of everything I buy in my life. My groceries have gone up more than 8%. Fuel's gone up more than 8%. My rent, if you're not in a rent-controlled environment, might have gone up by more than 8%. But anyway, you got the idea, right? So just the employers are adjusting for the government numbers, but people are complaining that the government number doesn't reflect reality. How would you respond to that?
Well, there are about 250 items in the consumer price index, and what you gave me, that scenario, you're saying one possibility is I don't fit the index. You're an oddball. You're not consuming what the average guy is. You're consuming in a different way, so you don't match the index. That's one possibility. The other possibility, and this is the reality, the perception thing, is that the things you buy most frequently, you know the price of. When you go to the grocery store, you know what's going up. So food, you focus on. Gasoline, you have to fill your car probably once a week or maybe even more frequently. Who knows? I don't know how long your commute is, but at any rate, if you buy things frequently and those things happen to be going up faster than the general price index, if those relative prices are going up very rapidly, you've got kind of a cognitive bias in the thing. You think there's much more inflation out there because the things you're buying frequently are hitting you in the face with high prices.
I don't want to get into outlier conspiracy theories or anything, but there is one economic theory I'd like to address and have you comment on. And this came from another economist I spoke with, and he said that the governments have a political incentive to underreport inflation because the Social Security payments are tied to the cost of living adjustments. And so if your CPI is lower, you're paying lower in cost of living adjustments every year. Does that have validity?
There is a certain logic in that, but this is not what is happening in the good old USA. The Bureau of Labor Statistics, all these indices that they have, I think they're reporting them in a professional way, and they aren't really biased. Now, they have gone in the recent past to not just the regular consumer price index, but what they call it Consumer Price Index for Urban Areas, CPIU, and that does come in a little bit lower than the old CPI, but not very much. And the reason that comes in lower, the CPIU does account for substitution that's taken place. In other words, if the price of steak goes up quite a bit, what do you do? Look, David Lin and Steve Hanke are not going to be buying as much steak. They substitute and put a little more hamburger or hot dogs in there.
I see.
In the meat category. So as a result, the price measurement for the meat category goes down a little bit. It's a little bit lower than before when we were only buying steak, you see.
I
So,
see.
so the CPIU, it is a little bit lower, not very much. It's not really a big deal.
That
It's
is
it's it's in fact a more accurate picture of what people are buying and what people are selling now each month.
that is an excellent point, Professor. Let's suppose I haven't considered that myself. But let's suppose that, let's take your steak example. Steak goes up dramatically in price, and all of a sudden nobody in that particular municipality or city can afford to buy steak. Let's just assume that's the case. Now, steak is all of a sudden taken off the market because there's no demand. And so when the people from the BLS come to collect the data, they're not collecting meat data from steaks anymore. They're collecting it from something that's lower in price. It doesn't mean there's no price inflation from steaks or other meats. It just means that they have to record things that are on sale, and those things happen to be lower in price because nobody can afford to buy steaks anymore. Is that happening?
Right. Yeah. Yes. That's what the
Yeah.
chain index roughly,
Interesting.
kind of lay terms.
Yeah.
That's what it does. So
Yeah. So I guess the
so
people.
a pound. Let's put it this way. Let's say you have a pound of meat.
Correct.
And the question is, what's the price of a pound of meat? Now, if you're only buying steak and that's the pound, the price that's put on that pound is a lot higher than if you're buying the pound and has some steak, some hot dog, some hamburger, and lower cuts of meat involved. So this substitution kind of effect does get picked up with the CPIU, this new measure that in fact is more realistic of what actually is going on now. Mm-hmm. So it is a superior measure. It's not something that the government dreamed up just so they could avoid paying Social Security price escalators. It's actually a more accurate measure, and it's been around. Economists have known about this for a long time, but it took the government, the bureaucratic wheels of government, moved pretty slowly, David. So it took them, they're on a slow learning curve. Let's put it that way.
All right. Well, we've got to get you on and debate one of these New York Times reporters one of these days. That should be a show. But in any case, let's comment on monetary policy. 25 basis points is what we saw. You mentioned earlier that this may not be enough to combat inflation. I'm sensing then that you disagree with a policy that's being taken today. Should we have seen a much higher rate hike?
Well, what we should have seen is addressing the monetary growth, because it isn't interest rates that you should be focusing on. It's the growth in the money supply broadly measured, M2. And right now, I said since COVID, that rate of growth has been about 20% per annum on average. It's come down. Now it's growing about 12.6%. And what they should have announced is it's growing now at 12.6%. And the golden growth rate, the growth rate necessary for the Fed to hit its inflation target, is about 5 or 6%. And our aim is to reduce that rate of growth from its current 12.6% down to, let's say, 5-6%, something like that. But the Fed is really flying blind because they don't even have the money supply on their dashboard. It would be like flying in an airplane where you didn't have an altimeter. That's a fairly dangerous thing to be doing.
Yeah.
Especially in bad weather. Now, if you're operating with visual flight rules, you're okay because you can see what's going on, and you can see if you're going to have it crash into the ground or hit a mountain or something like that. But what if you are in bad weather?
I think the analogy here is
you can't fly with visual flight rules. You have to be flying with instruments. Then you got a real problem. You might hit a mountain.
Well, I think maybe the analogy is maybe they've already hit a mountain and now they're salvaging the damage.
Yeah, right? Well, you're right. They've made this mess, and they've made it by excessive monetary growth. And the only way you can fix the mess is by slowing the rate of growth down and getting it into what I call the golden growth rate zone of about 5 to 6%. You would in the United States see an inflation rate of around consumer price index headline number around 2%.
Well, Powell did indicate in the meeting that he would potentially see the Fed reduce their balance sheet starting in May. I'm just going to read a paragraph here from their statement from today. The FOMC expects to begin reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities at a coming meeting. I don't know if this is going to be enough.
Again, it depends on how much they reduce it and whether they get the thing calibrated right. And the only way to do that is to be focusing on M2. That is a number they have to be looking at. So they have to be looking at the right target. It's one thing to wave your hands and say, we're going to reduce the balance sheet, but for what purpose and where's your target?
How can they physically reduce M2? How does that work? I mean, I understand reducing the Fed's balance sheet, but M2 is already in the hands of, other consumers, corporations, whatever have you. It's already in the system. How do you take it out?
Well, they're not talking or contemplating sucking up the excess that's already out there. They're talking about slowing the rate of growth going forward.
I see.
That's why I say this excess is already out there. We've had the money supply grow by 41% since February of 2020. And of that, about the excess amounts to about a 30% increase. The 30% is an excess that's hanging around and eventually will get out into inflation over the next 2 or 3 years.
Okay, let's finish on gold. Gold's response today, we talked about, it was up on the news. Now, you had foreseen this slightly with your indicator, the Hanke-Cofnas Gold Sentiment Index. So it parses the internet for keywords that may tell you whether or not sentiment right now is bullish and or bearish. So what does the sentiment tell you right now? Well, what has it been saying the last couple of days? And let's talk about what it's been saying now.
Here's what it's been saying. It's been saying things were very bullish before the war started in Ukraine. Right before the war started, they were very bullish. The scale on the Hanke-Cofnas Gold Sentiment Indicator goes from -10, that's the most bearish, to +10, that's the most bullish. And before the invasion, the reading was 6.32, and the gold price was up, almost $2,000 an ounce. And then after the invasion, if we look yesterday, what was it? It was -5.85. So that we had a huge swing in sentiment going from very bullish to very bearish. And so you could fade this market. The signal was, ride it up, and gold was peaking out in price. But at the same time it was peaking out in price, we're getting sentiment shifting back from bullish to less bullish, less bullish, less bullish, and all of a sudden bearish. So you should have been fading that market. You should have been long going into the invasion, ride it up, and then fade it away. Today, look at the difference that we have. We were at a reading of -5.85 yesterday, and today we're at -0.17. We're neutral today. So we've gone from quite bearish yesterday to a neutral position today. And the reason for that, by the way, is the expectation of what the Fed would do. The Fed came out kind of dovish, and the market, ended up moving up a little bit. It solidified itself. The gold market did.
Sure.
So we've been using this. By the way, it is what we do. Every hour we look at all the articles on gold, and we mine those articles with what they call text mining, David. Different words are bullish, different words are bearish with regard to gold. So the computer is mining these things every hour, and we're getting a reading for the sentiment every hour, very high frequency data. And we can also indicate, now we've been reading these technical charts on sentiment enough that we can indicate turning points when things are switching on you. And now we've been, as you know, we've been building this thing for over a year, and we now offer this to people who want to buy it for $15 a month, and what's called a gold package. And they go to the goldsentimentreport.com and they can find that. Just punch in and you can find out. And you'll get, by the way, the gold package, what's in it. They'll get 6 readings a day of the gold sentiment score, and they'll get alerts whenever there is a turning point in the sentiment. And those alerts end up being very important because, of course, that's what traders have to worry about. You know, we send out an alert. We said, oh, the thing looks like it's really turned from bullish to bearish, and that we picked up, for example, right away in the Ukraine invasion. Worked very nicely for that.
Okay, well, yeah, excellent trading tool. You should open up a fund and trade on this. But that's
we're moving in that direction. We've been back testing this since July, by the way, with these turning point signals, and that back testing, that's not actual trading. We're back testing. We're up about 20% since July. No. Just trading on these turning point signals. Okay. So far, all is good, and it is pointing towards precisely what you suggested. It's starting a fund. Okay, well, we'll definitely follow up and keep the audience updated on that development. So I'll put the link to the gold sentiment report in the description below. It's the goldsentimentreport.com, and it's the link to the gold package that you just talked about. So you get 6 turning points a day. That's for available at a pretty modest price of $15 a month. That's a kind of a no-brainer, actually. All right. Well, I can either choose between Netflix or Hanke's gold turning point. So yeah, there's no question. You get the turning point is towards the gold sentiment report. There's no question about it. All right. Excellent. If you're trading gold, I mean, if you're a couch potato and watching movies, Netflix is the way to go. Ideally, you do both in a perfect world. All right, Steve. Well, I can't. I mean, inflation, it's eating away. I got to cut down my monthly expenses. The inflation tax, assuming your real income is going up, you can do both. Yeah. If you haven't anticipated the inflation properly, your inflation tax is going to be eating your nominal wage up, and your real wage will be falling. Yeah. By the way, you and I have already filmed, this episode is going to air today, but you and I have already filmed an education episode. So we're doing a 2-part educational series as part of the Kitco education program. And the first episode has already been filmed. It's inflation for beginners. We've explained all these rudimentary concepts that you brought up already. So the CPI, what's in it, you talked about that. We went into greater detail in this educational program and episode. So stay tuned for that. If you're watching, it'll be released shortly. Thank you, Professor, for coming on the show today. Thank you, David. Have a good evening. You as well. And thank you for watching Kitco News. I'm David Lin.